Hi, I'm David Stein of Money for the Rest of Us, and today I answer the question, is now the time to sell your stocks? So I just finished the July investment conditions report for members of Money for the Rest of Us Plus. This is an exercise I do every single month to get an objective look at market valuations, economic trends, and market internals, which is the level of fear and greed. Now, many financial YouTube channels do the 5 stocks or the 3 stocks I'm buying in July or the 3 stocks I'm buying in August, and they do it every single month. I don't buy individual stocks, and most people shouldn't, because we're trying to save and manage retirement assets, which means we need to be focused on asset allocation. Now, I recently got an email from a listener to my podcast, and he asked about that. Well, he says, I understand long-term asset allocation and the importance, and I've done simulations, Monte Carlo simulations, and I know I'll have enough to retire. But I'm 55, and my biggest concern is what happens if the market falls 50%? Then my retirement is overwhelmed. And he really talked about a black swan, some event that really took markets down. And I can empathize with the situation because I'm retired too. I'm dependent on my portfolio for much of my living expenses on a day-to-day basis. And so I look at markets once a month. I take an objective view because I'm looking for a regime change, something that suggests risks are high because the economy is deteriorating or some other event. Valuations are super, super high, but a trigger, something that suggests the risk of a market sell-off are high, and then I reduce my exposure. So these are rare. That doesn't happen very often. It happened in 2007, 2008, and 2009. It happened in 2000 when the internet bubble. And so these don't happen very often, and it usually occurs with some type of economic regime change, a recession or something along those lines. And so I'm looking objectively at market conditions to see if recession risks are high and the chance of a sell-off are high. And frankly, right now, as of July 2017, investment conditions are neutral. When we look at economic trends, and my primary measure looking at economic trends is what's known as PMI. These are business surveys done around the world. They're done monthly, where economists ask, or statisticians ask businesses, how's business? How's orders? How's your inventory? What about your employment plans? And then this data is aggregated together, and it's called a PMI. And if the measure is above 50, it typically suggests the economy is expanding. And if it's below 50, particularly below 48, the risk of a recession is high. Now, it's done around the world, and then it's aggregated together in something called the Global Manufacturing PMI, the JP Morgan Global Manufacturing PMI. And right now, that is at 52.6. Its long-term average is 51.4. And so many people they're worried about a recession. You don't need to be worried right now because the risk of a recession is low. And that's what the economic data says. Now, when we put that together with valuation data, valuations are high for the stock market. When we look at the price to earnings ratio of the global stock market as measured by the MSCI All Country World Index, it's above 20. The US S&P 500, for example, its PE ratio is well above 20. But just because markets are overvalued doesn't say that they're going to fall or a fall is imminent. In fact, the global stock market is up 11% this year. And it's had a tailwind because corporate earnings growth is expanding. Year-over-year earnings growth for global stocks is around 8.8%. And analysts expect earnings growth to increase at 12% over the next year. In fact, over 70% of analysts around the world have raised their estimates of earnings. And Ned Davis research shows that when more than 60% of stocks' earnings estimates have been revised upward, typically earnings growth the next year has been about 18%. When less than 60% of earnings revisions are up, then earnings have fallen 8%. And we're in a period where there's a tailwind because corporate earnings growth is expanding. And so even though valuations for stocks are high, they're getting less expensive because earnings are increasing. And with the backdrop of an expanding economy, things look good on that front. Now, one of the concerns is what are central bankers doing? And the Federal Reserve has raised interest rates several times. The European Central Bank has hinted that they're going to reduce some economic stimulus. And so recently, in the last couple of days, the weeks, interest rates have been rising. Now, it's normal for interest rates to rise when the economy is expanding. The question is, will they rise so much that it kind of contradicts the tailwind of earnings growth? And that's something we have to wait and see. And one way the indicator of that is to look at what are called market internals. What are the trends? What is the momentum of markets? And right now, the trends are favorable. The vast majority of markets and stocks around the U.S. are in an upward trend. They're above their 200-day moving average. It's sort of how we want to look at it. Are most markets and stocks above their 200-day moving average? Because that historically has been associated with a rising stock market. And so that's one of the market internals that I look at. We look at this trend. When we look at the rate of change, that's what momentum is. Trend is the direction. Momentum is the rate of change. Momentum is neutral right now. And in some indicators, they're bullish. And then we've had this exuberant stock market or investors, and they've sort of pulled back a little bit. They're not quite as exuberant, and that's actually a good thing. And so when we look overall at the stock market, in terms of investment conditions, July 2017, we're neutral, which suggests you should stick to your long-term asset allocation plan and not sell all your stocks. There's a time when you might want to reduce risk, but we'll look at the indicators, and it's something that I do for listeners on my podcast as well as members of Money for the Rest of Us Plus. We're looking at it monthly, and as of mid-year, July 2017, conditions are neutral, suggesting sticking with your long-term investment plan. Just to remind everything I've shared with you is for general education. This is not investment advice. And hey, if you like this video, go ahead and subscribe to my channel. You can do that just below the video. If you have any questions on this analysis, you can put those in the comments. Thanks.